Dollar cost ravaging.
Dun, dun, dun.
What is that? Why you need to know about it and ways to avoid it. The old school way of thinking with Wall Street is intensely flawed, and we're going to break down one of those ways right now. I'm Mark McKay with Sage Smart Solutions.
And I'm Marcy McKay.
Thank you for joining us. Please like this video and subscribe to our channel, and join us weekly as we explore new and exciting ways to protect your assets and retire tax-free. Get Uncle Sam out of your retirement plan. So, dollar cost ravaging. We did a piece a couple of weeks ago, and I wanted to talk about terminology and how a lot of times people will throw out phrases without really explaining them. And dollar cost averaging is that's just a financial term. It's
right.
Whereas dollar cost ravaging obviously has a little bit of flavor built into it as to what it implies. But dollar cost averaging is when you're putting a fixed dollar amount into an investment, say on a monthly basis, on a systematic basis, and it's, what's the oldest adage in investing?
Buy low, sell high.
Dollar cost.
I hate it when you do that when I know the answer.
But you also hate it when I don't, and I let you sit there with that pregnant pause. And I knew you knew that one. I just didn't know if you knew that was what I was going for. So, dollar cost averaging forces you, when the price is high, you don't buy as many shares, and when the price is low, you buy more.
Right.
So it's systematically efficient.
But people tend to do the opposite.
Well, not with systematic investing.
Right.
That's the way it works.
Yeah.
But they also intentionally and systematically do just the opposite at the more important point of the retirement process.
Okay.
It's not about how much you have in some piece of paper that some guy you play golf with is going to be impressed by. How much of that can you turn into tax-free, reliable income?
Right.
Or how much is it going to be after taxes? So, dollar cost averaging works in your benefit. You automatically sell less. You automatically buy less when the price is high, and you automatically buy more when the price is low.
Right.
So when you've got a systematic withdrawal, so the old school, your broker, your Dave Ramsey's, your Susie Ormans, these guys that are like, do your match in your 401k and max out your this and that, put it in 25% equity, 25% bonds, And that rule of thinking, that industry, that way of financial planning has always said, not always, but they've reduced it down to the 4% withdrawal rule.
Right.
We're going to get a little bit into detail on that on a future video where we really break down some spreadsheets. It can be a little dry, so if you're not into it. But the 4% rule was Wall Street basically saying, okay, as long as you don't pull out more than 4%, a 60% blend of stocks, 40% bonds, you live to be 85, you've got a 70% chance that you won't run out of money.
Right.
They've actually just come out, and I'm going to put some numbers here in front of you so you can understand it better. But they're coming out, and a lot of people are saying it's 3%. Oh,
that's a big difference.
So, and even with 3%, let's say you're only pulling out 3%, and you've got a more aggressive blend of 80-20, 80% stocks, 20% bonds. You reduce your chances of running out of cash in retirement to 21%.
Okay.
So if you look here, I ran the numbers, and with a conservative 4% withdrawal rate, the Wall Street way of thinking, you run out of money 45% of the time. That's why they had to switch to the 3%. But at 3%, you still run out of money 21% of the time. And I know that's pretty good odds. But if you're about to get on a plane and the pilot says, you know what, we're successful 79% of the time, are you getting on? Great investments say, okay, you can pull out 3%.
Right.
So, and they protect themselves from dollar cost ravaging by saying, pull out 3%. Not realistic. Guess what? My expenses are not dependent upon the value of my 401k or traditional IRA.
Right.
I need $7,000 a month.
Right. You need more stability to
cover
know what to expect.
But so dollar cost ravaging is when you've got a systematic withdrawal, and you won't say, give me 3% of my account. you'll say, you know what, I need $10,000 a month. One, because I know that it's coming out of a 401k or an IRA and I have to pay taxes on it. So if you're going to do it, you put in your order to liquidate $10,000 a month. When the price is at, that's a 1, the price is at $1,000 a share, your $10,000 is going to require you to sell 10 shares, right?
Right.
Let's say the price goes down.
Okay.
To 5,000. I realize that's extreme, but doing it for simple math. So, if your investment has gone down from 10,000 to 5,000, I'm sorry, that was 1,000.
Right.
So that would be 500. So if your investment goes from 1,000 to 500, how many do you need to sell to get the same 10,000?
20.
20 shares.
Woohoo!
So what did you do here? When the price was high, we didn't sell as much.
Right.
When the price was low, we sold twice as much. So I'm just going to use these 2 months for simplicity. Let's say the average price of this is $750. That is a 5. If you need me to work through that math, just let me know. So the average price is $750. We sold 30 shares and we got $20,000.
Right.
So that means that our value of the shares was only like $667.
Right.
I can work that math out too. So you actually, you got less than the average price of the stock. So where this is really critical, this is just a bad strategy and a very volatile asset. Think about if you had a systematic withdrawal, how much of a difference it would have made. And we're doing this in the first week of May. If you pulled the money out on Wednesday, it would have been worth a whole lot more than it was on Thursday and a whole lot more than it was on Friday. It's just not a good plan.
So is this whole example dollar cost ravaging?
This is dollar cost ravaging. And why this is so bad is because once you're in retirement...
Is it ravaging your savings?
Well, you're dipping into principal, yes.
Okay.
You're eating up your asset.
Okay.
So, if let's go back to the 3% rule. Let's say you've got $4 million. You put your money in your 401k, you did their blend of 60-40, 70-30, 80-20, whatever it would be, ended up with $4 million. That is a 4, and those are M's. If with the 3% rule, which is what Wall Street is now saying, you can pull out $120,000 a year. Doesn't sound bad. The average guy that has $4 million in his retirement account probably took home more than 120, but you listen to Dave Ramsey and these guys, and your expenses are going to go down in retirement, or your taxes are going to go down, and your expenses. They're not factoring in healthcare. Yeah. That blows any argument that your expenses are going to go down. You might have your house paid off. Great. Oh, you lost that tax deduction. Anyway, so you've got $120,000 off this huge portfolio.
Right.
Uh-oh. Is it really 120? No.
What, have they paid taxes yet?
It's 90K. Because, and that's me being generous, that taxes are going to be at 30% on this kind of a income level in 5-10 years.
Right.
So $90,000. So that's $7,500 a month. You have $4 million. You're getting $7,500 a month. I don't know why I'm doing percentage. $7,500 a month from a $4 million asset. This is impressive, but so what?
So $7,500 instead of $75,000?
No.
Because this was $120,000.
A month.
Oh, a year.
A month. Yes,
okay,
I'm sorry.
So that was
I divided
per year.
I divided by 90.
Okay.
It would be $10,000
okay.
a month.
Okay.
Thank you. I switched.
I was like, that sucks.
I switched units here. So 90K is $7,500 a month.
Okay.
So, which is not bad.
But still, there's a big difference between 90K per year and 120.
And the reason they had to do that is because at this 4% rate, when you're going into an asset that goes like this, What if you retire here
Right.
and you pull out your 4%?
Right.
And the stock market goes down 30% and inflation goes up 8%. Is that a solid plan?
No, it feels like going to Las Vegas and gambling with your family's financial future.
And
just hearing you explain that gives me a knot in my stomach.
well, and the thing to think here is, okay, we can't control how much the market's going to go up or down.
Right.
We can't control how much Congress is going to charge us.
Right.
You have a deal with Congress that you'll pay them, they'll pay the taxes on your 401k, your traditional IRA, your 403b, your 429 at some point in the future. And they get to dictate the terms.
The other thing I thought of is how scary this is, all things you can't control. The stock market, what Congress is, they're out of control spending,
Well, especially if you've got, let's say you've got 80% of your retirement assets in tax deferred buckets.
Right.
You don't have control. You don't have choices. That's one thing I always like to stress when we do a plan. Let's have flexibility. Let's have options in the future so that when taxes go up, when the market crashes.
Right.
So
so you can keep as much of your money instead of giving it all to Uncle Sam.
Or to the fat cats of Wall Street who are manipulating these equity markets.
I thought I did really well in this.
Yes, your chalkboard skills are excellent. So, what can we do?
Yes.
I know it's naive for me to think that most people won't have some sort of a tax deferred bucket.
Right.
There are a few people who buy totally into the 0% tax bracket, and if you're one of those people, let us know. We'll set you up. But most people are going to have some sort of a tax deferred account. And the other problem with that $7,500 that we showed in the previous example,
What?
It caused your Social Security. It caused 85% of your Social Security benefit to be taxable.
Ooh.
So not taxed at 85%, but 85% of the benefit. Don't you feel like you already paid taxes on that money?
Exactly.
So what can we do?
Right.
We need a buffering strategy. We mentioned we need buckets. We need options when we get to retirement. So if we have talked about the SAGE strategy that provides a big bucket that you can access tax-free. The other bad thing about that systematic withdrawal?
What?
Let's say taxes went up and the market's down, and it's time for little Susie to get married.
Right.
Or it's time to take the kids to
Disney World.
Disney World.
Or,
And you have to think, okay, do I want to take this loss and do I want to pay all those taxes? Don't let those things be a factor in whether you get to go fishing or not.
Right.
It's just there are better ways to do it. So what can we do?
So you said number one, the SAGE strategy has a buffering.
I didn't say number one, but I know the SAGE strategy provides a buffering option. So let's say we've got half in SAGE, half in Las Vegas style 401k. I don't know where I'm going to write now, but so we're going along. We know how much we need every month, and a week like last week happens, and we need to pull out some money. If we have options, if we have done real planning and not said, oh, no, that's not a good investment. I don't care if it's a good investment. It is a good financial plan. It is a good savings vehicle that, if done correctly, will beat all your investments. So if the market is low and I need money, I come over here and we borrow it from the SAGE method. I know I took my labels away. If the market's high and we think, might be time to pull some money out of that one, we come over here and we pull it from the 401k. And we've got the numbers that show that using a strategy like this can make your IRA last 15 years longer in retirement before it runs out. And if you remember with your IRA or your 401k, the government is going to tell you at some point that you have to start taking required minimum distribution and you have to pay taxes on it. So you don't want all your eggs in that basket. Look at market volatility, look at rising interest rates. There's one reason that taxes are going to be higher in the future, and it's a 4-letter word. Do you know what that word is?
A 4-letter word. Math?
Math. Woohoo! See how I waited for it?
You didn't even like mouth it. So.
Math. You cannot make the numbers work for a case. I think in 2037, just the amount of interest that we pay will be equal to the amount of revenue that we raise as a country.
Gosh, that's so scary.
It is scary, and it's going to result in market volatility, probably an extended, 10, 15 years of depressed market returns, but extreme market volatility. Make sure you've got, I know this just doesn't say anything, but we can pull this one out and you don't even have to tell the government that you pulled the money out of it. That's what's so beautiful. You pull the money out of your IRA, your 401k, your 403b, your 429, you're going to get a tax bill. They are going to tell the IRS. And you know what? Let's say you pull $1,000 out of your IRA and you say, you know what, go ahead and withhold 20%. You got to pay taxes on that 20% you withheld and sent to the IRA, because that's a taxable distribution also. Anyway, make sure that you have some tax control that provides safety, security, liquidity, flexibility,
and a buffer,
and above average returns.
Yeah.
Thank you very much for joining us. Please leave us a comment below. Subscribe to our channel. Let us know if there's any content you would like to see specifically.
You're so passionate. I feel like confetti should be falling at this point.
It'd be good as long as I remember to tell people. We are also going to have a video coming up soon where we walk you step by step on what it takes to get the process started. I saw a beautiful story. I'm going to go off on a tangent now. No, I'm not. We're going to say that for later, people. Have a great week.
Thanks.
End. If you're watching this on a big TV, go ahead and scan the tire cover there, and it will take you to our YouTube page on your phone so you can have access to our Masterclass, a link to set up an appointment, or anything else that you might not see on a TV.